Selling options for income can seem very easy, but there's just one big mistake that everyone has to avoid in order to make selling options a consistently profitable strategy. If you find yourself having a hard time generating consistent income trying to sell options, hopefully this video will be the changing point. Welcome to the channel. This is Credit Spread Investing. My goal is to show you how to generate consistent profits from trading and investing. If you like content like this, please consider liking the video and subscribing. It will really help the channel out. If you're watching this video, you probably already know what a put and call options are and how selling options mechanically work. But we'll touch on it briefly for those of you who are new. By selling a put option, you're essentially guaranteeing someone that you will buy 100 shares of that stock at that specified strike price at the time of expiry. In return, that person will pay you some money for that guarantee. If it's above the strike price at expiry, nothing happens. You collect the money and you move on. If it's in the money, essentially below the strike price, then you as a seller of that option have to buy 100 shares of that stock at whatever the strike price the option is priced at. So let's just take a look at a real life example. I'm going to use Delta as my proxy, which is currently trading at $40.27 as of today. This is an option chain that you'll see on any brokerage platform. This is Thinkorswim. The ones in parentheses, days to expiry. And we're just going to choose the 37 days to expiry, January 19, 2024. There's a call side and the put side. I'm going to do an example on selling a put option. Right now it's at 40, so if you sold one at the money, you would collect $146 right off the bat. But let's do something that's a little bit more realistic. Let's just do $36, put option expiry, 37 days later. I would collect $36 right off the bat. And let's just demonstrate how this works. If Delta were to be above $36 on January 9th, 2024, buy market close, I would keep that $36. Nothing would happen. I'm not forced to buy 100 shares of that stock. But if Delta were to go to 35, for example, or 34, I would then, as the option seller, be forced to buy 100 shares of Delta at $36, regardless of whatever price it would be at. I get the money up front, and the chances of Delta going below $36, which is a 10% drop within a month, is very low. I can collect 1% of the total tied up money or collateral in a month. If I were to sell even more aggressively at 38, for example, I can collect even more money, and even then, Delta may not even fall 5% within a span of a month. Now, if you did it with other stocks, maybe even more volatile stocks like Palantir, you can collect even more money, right? So this is why this is so desirable or so attractive, right? And this is why a lot of people tell you to sell puts, because it's a low risk strategy to help you generate that passive income. But that's not always true, because if it's done incorrectly, by making this mistake that we'll talk about right now, this will be an easy way for you to consistently lose money. So for any option strategy, we have to understand the risks as well as the reward. Now we've talked about the reward, let's talk about the risks. I'm going to use an example that I found on YouTube about a person demonstrating how he sells options by showing you what I mean and how he's making this critical mistake, right? I'm not going to call out who this person is or link the video. It's not about that. It's just a good example to demonstrate the worst case scenario and how to avoid making this mistake. This person, let's call him Bob, sold Riot a week out at a $54 strike price. Riot was at $60 at this, which means the stock has to drop 10% to get assigned, right? It seems like it's a very safe trade. On top of that, he collected $1.70 per contract and actually sold 7. If you look at the return on invested capital, the amount of money that is quote unquote tied up because of this one trade, it's around 3%. Let's look at one contract, collected $170 per contract. And if the option gets assigned, he'd be forced to buy 100 shares at $54. And so that's where you get the 3% from. You can see the return is actually very high for very little work. And he can make 3% week over week. And that's why it's so compelling, right? Let's assume Bob or you took 3% every week and did this every week for a whole year. Do this for around 48 times. Your ROI would be 144%. This is obviously massively exaggerated. And without context of understanding the risk, you would be like, this is easy money. I can see myself doing this. First one, the one that he just sold, expired out of the money. So he collected $170 times 7, put that in the bank, and moved on. Nothing happened. Then he sold another 7 at the same strike price at $54 for $217 now on the 22nd, with expiry of weekend the 26th. Now, this had an even higher return on invested capital of 4%. However, in this case, this option, this put option, ended up in the money at $48.22. And he was assigned and had to buy 700 shares of Riot at $54 a share. Let's just do the math up to this point for one options contract. You can multiply this by 7 at the end. He collected 217 plus 170 for those 2 contracts that he sold, $387 in total credit collected. But because he got assigned, so he had to buy those shares at the $54 strike price, even though it's at $48.22. Actual ROI looks more like this. He's down $578 on the stock itself because it was worth $48.22 the moment he bought it, but he bought it at $54 a share, right? So that's $5.78 difference times 100 shares. It's $578 right? So the total loss he incurred on buying those shares is $578 plus the $387 that he collected. He's actually only down $191. Divide that by the total invested capital initially, which is $5,400. He's actually only down 4%. And you'd be like, okay, well, credit spread investing, like this is not that bad. A seasoned professional would be like, all you have to do now is to sell a covered call on it. If you sell it above the 54 strike price, you'll never lose money. This is easy. Bob even said he can sell the covered call at $54 and make that money back easily. The video ends the moment he gets assigned up to the second put, and he buys 700 shares of Riot at $54. But we're going to continue this options trade here so that we can demonstrate why this one mistake is so important to avoid. I went back in time and I looked up the option pricing for March 2021. As you can see here, collected $200 on this one option that he said he was going to sell. At this point, he immediately makes back his losses. Riot never got to $54 for his covered calls. And this means covered call never got assigned. But what happens next is the most important thing I want you guys all to understand here. Until 2023, you'll see a downward slope for Riot. That Riot never got back to $54 a share. I don't know what he ended up doing, 54. Maybe he sold out, maybe he didn't. Who knows? But let's just walk through a couple scenarios to demonstrate why this is the worst case scenario, right? Scenario number one, if he held it, Riot went all the way down to $3 at one point, which means the stock went from $54 to $3, which is a $51 decrease, which means that he lost $5,100 per contract on just the asset value, the stock itself. Bob actually sold 7. So at this point, at the low point, his unrealized losses from the 700 shares of Riot stock that he owns is actually $35,700. And as he continues to sell covered calls on the way down, the option pricing, the amount of money that he can get, will get lower and lower and lower as the stock value decreases. So if we were to simulate this, and let's just be aggressive, and says he collects $50 a trade for the rest of the trade, which is probably not going to be possible, especially when the stock is trading at like $3, Bob would need $5,100 divided by 50, which equals 100 trades, and that's assuming he sold weekly. He would need the 100 weeks to make that money back, which is around 12.5 months, which is around a year, give or take, right? And this is assuming that the options never got assigned and assuming a $50 contract, right? If it was $25 or even $30, you can see that's going to be 2 years, which is quite possible because that's the option pricing at the moment. And he's probably going to have to sell it at a loss anyways because the moment that the calls get assigned, if it does get assigned, he's going to lose on the realized losses on the stock. This is obviously an exaggerated example to a certain extent, but it's not an uncommon situation. You can see a similar pattern with other stocks like NEO, Oatly, especially small cap stocks, and even larger cap stocks to a certain extent like Disney, Delta. Let's do a quick scenario number 2. He never ends up selling, still holds Riot because he believes in it, right? Even after this massive run-up of this year, Riot is still trading around $14 a share at the time of this recording, which means he's still down $40 a share, $28,000 total. If Bob had just put the same amount of money into S&P 500 from March of 2021 to today, he would be up around 20% instead of being down on the trade. I'm not only going to use Bob as an example. I also have these losing trades, and sometimes you do lose money, but it's important to understand the nuances and differences when it comes to generating income from assets. The first point here that I want to make is the asset that you're selling, the stock or the company that you're selling options on, especially cash secured puts, are very, very, very important because the amount of income that you're collecting will not be able to cover up the unrealized losses on the stock if the stock never has the potential to recover in share price. Really important. So I bought Intel around $40 a share, but I did sell cover calls on them. And throughout that time, I held Intel. I collected around $72. The moment I sold it at $28 a share, I lost around $1,200 on cover. I was contemplating selling cover calls on it until I got back to 40, similar to what Bob was trying to do with Riot. Now, if I had done that, you can see that Intel recovered all the way up to $40 a share. Now, when you compare Intel and Riot, the charts look very, very different. The difference between the two, what I'm going to say here is an oversimplification, but in a nutshell, Riot stock was overinflated. The business itself has no ability to generate profits. Intel, even though it was beaten down, had a steady cash flow, established business model that was generating consistent profits. And so when the market recovered and when Intel showed promise in increasing its cash flow and reducing business expenses, the stock itself subsequently recovered, right? So the difference is the company and the stock itself that Bob and I were selling cash secured puts on and covered calls on. Intel is a much more valuable company, and the stock itself wasn't overvalued where it was impossible for the stock itself to recover, right? There was not that much differentiation between the stock price and the company. So what we're going to wrap up here, but we're going to be crystal clear about what the mistake is and how to correctly view trading puts for incomes. The most common mistake is that most people view selling options as an easy way to make money and prioritizes income first. They don't even consider the stock that they will have to buy when they get assigned. They're always thinking, well, if I do get assigned, I can always sell cover calls in it until it gets out. You can see you can't always get out, right? You can always choose a bad stock and it only goes down and stays down. And when you can't, the stock price can wipe out any of that income that you collect if you're not careful. Every strategy has its downsides, and everyone should be aware of how they lose money and how much they can lose. So here's the most important takeaway said in a different way. The asset, aka the stock and the company, is the most important thing to consider when selling options, because when it does go south, you can lose a lot of money because the income generation will not have a larger impact than the losses associated with the stock price dropping. Right? Don't view selling options as only generating income. Use it as a tool to acquire good stocks at good price points while collecting income as a secondary driver. If you want to see more details on how to safely sell options to acquire good assets and collect safe and consistent premiums, make sure you check out this video link in the end screen here. And if you found this information helpful, please consider liking and subscribing so you guys can all generate safe, consistent income and grow your portfolio in a sustainable manner. All right, until next time, stay safe in the market. Peace.